Hey, well, welcome. I am Matt Price. We have Matty Kearns here as well. This is the June edition of our monthly market update. Randy sends his regards. He's actually on an anniversary trip with my mom, 35, 36, 37 years. I forget how many, but I think they're going to make it. So what we're going to be talking about, and I see as the names are have a few names still signing on here, quite a few clients, a few people who are not clients. So as we go to the next page there, just a refresher with who we are. We are the Price Group. We have a retirement niche. Over 80% of our clients are retired. We think it's important. We follow a fiduciary standard that's paramount. 50 plus years of experience between the three of us. I have almost 15. Matty has 5, Randy obviously with the majority of that. We operate as a team. So really important, we think, from a standpoint, we have Randy's proverbial gray hair on the investment committee helping us make investment decisions for each client family. But on the next slide there, a little bit about our firm. Or more here, Randy's gotten quite a few awards. I've had a few as well. Our team has had a few as well. We've been humbled by that. We're both certified financial planners, Randy, myself, and Matty. Randy and I have our CIMA designation, Certified Investment Management Analyst. We think education is really important. That's something we take very seriously. And so about our firm, Steward Partners, based off the biblical definition of stewardship, we think it's important. We're not owned by a bank. And what that means is we can serve as a fiduciary. Raymond James serves as our primary custodian. Custodian just meaning where client assets are held. They've been a good partner over the years, run a very conservative, fiscally conservative operation. So well, let's jump into the kind of what we have to do. I'm going to talk a little bit about the consumer. We've gotten actually a lot of questions on stock splits here recently. So Matty's going to cover that and then have a few more slides just on holistic investing and how we look at the world. But here's what we've seen over the last few months as it pertains to the consumer. There's a little bit of a bifurcation going on with families who make more than $100,000 and families that make less than $50,000. You're seeing the families making over $100,000 are kind of pushing the economy forward. And what I mean by that is that they are continuing to spend. So the chart there on the right, you can see the black line of income of 100,000 plus. People are still spending, unfortunately, under the $50,000 income threshold, which is the grayish line. Some of that spending has stopped, meaning they're looking for cheaper alternatives or not buying any goods or services altogether. Why is this important? Why are we talking about this? Well, about 2/3 of the economy is based on the consumer spending. So it's something that we follow closely. I used the word bifurcation earlier. We're seeing a little bit of that, but for families who are making above $100,000, which actually represents a majority of the spending is still in what we consider positive territory. So looking at the next slide there, kind of in a contrast to that though, the demand for big ticket items has been moving lower, and big ticket items could be anything from a new dishwasher to a new car, just anything that is not part of your routine monthly expenses. And we've seen families really reducing the number of families really reducing any big ticket items that they're planning on here in the foreseeable future. So sometimes that's what we call a leading indicator of when there could be a potential recession. Right now, though, we think the consumer as a whole looks healthy, and some of these numbers can, as you can see in this chart, be a little bit seasonal, where people are not doing as many big ticket items usually during the summer months to begin with. But overall, we think the consumer's healthy, and something we continue to monitor closely.
Thanks, Matt. I'm going to touch on stock splits, as he mentioned. Matt said we like to tailor the topics of our updates here to the questions we're getting from clients, and they have been asking, what are all these stock splits we're hearing about? You can see here, Google searches for stock splits have peaked again now that NVIDIA has completed or announced and completed their stock split earlier this month. We've seen this before with Amazon, Google, Apple, Tesla, when they've announced their splits historically. But interestingly, stock splits are at their lowest level, the number of splits, almost ever. They kind of peaked in the late 1990s, early 2000s, and now they're the lowest they've ever been, even as stocks are at the highest that they've ever been. And so the question we're getting from clients is, what are these stock splits and what do they mean for us? And so we go to the chalkboard here, do a little stock split math. Basically, in a conventional stock split, the number of shares increases while the price per share decreases, leaving the overall value for an investor the same. So in a 5-for-1 stock split, if I owned 100 shares of stock ABC at $1,000 per share, I would have $100,000 of that company. After a 5-for-1 stock split, the shares go from 100 to 500, but the price goes from 1,000 down to 200 per share, meaning my position value has not changed at all. So for an investor, there's no fundamental difference. And that begs the question, why would a company do this then? There are a few reasons we've identified. First is sentiment. Essentially, it makes the stock look more affordable. $1,000 stock looks expensive compared to a $200 stock. And so it makes it more affordable, more accessible to the retail investor, and even looks like it's on sale, a little bit cheaper. That increases liquidity, helps trading go more smoothly. Options in the options market, it makes them a little bit more affordable as well. We think one of the important ones, especially for these tech companies that are incentivizing all of their employees with all these stock options and stock, it makes that logistically easier for them and helps them get included in some of these indices. So that's a little bit about how it works and why they do it. But another question we get is, do stock splits impact the performance of the stock? What we've seen here is that after a stock splits, the stock performance does, in fact, on average, outpace the S&P 500. And that's true if you look at since 1972 or even since 2010. A stock that splits does tend to outperform the S&P 500 after it splits. But is the split itself what's causing the gain? And what we found is that stocks that split have had previous recent outperformance. These are stocks that are outperforming before and after the split. And that's what you can see here. In the 3 years prior to the split, these stocks on average are outperforming the S&P 500 tremendously. Same can be true for earnings per share and sales growth. Both of those are outperforming the overall market prior to the split. So essentially, the data is showing that the split doesn't cause the outperformance. In some sense, the split is evidence of the outperformance itself and the strong fundamentals of the firm. And think about a promotion at work. An employee who gets a promotion, they would seem more likely to have future career success compared to the employee that was not promoted. But the promotion was earned with years of hard work and strong performance prior. It's evidence of a loyal, dutiful employee, the kind of employee that will continue to have success in their career. So should we be on the lookout and be buying any company that's had a recent stock split? Not necessarily. I think, in fact, we should be looking for companies before they split that are experiencing this successful outperformance prior to the split.
And thank you, Matty, very, very helpful, kind of a real, what I would consider dense topic there. You explained it with ease. One maybe operational note to make for clients on the call: typically companies will do a split on a Friday. And so this happens over the weekend. But we did have a company that had a stock split earlier this year in one of our stock portfolios. And over the weekend, it showed for one day an inflated value in there. So it takes the system an overnight cycle to kind of clean this out. So we'll just kind of keep an eye out if you do hear of a company having a stock split and you look at your online portal and it's worth 3 times as much, it's probably going to be retroactively changed back the next day. Just from a standpoint, it takes them one full overnight cycle to kind of process that stock split for client accounts. So here's another question we've gotten recently. The old saying is sell in May and go away. What that means is, does it make sense to just own stocks from January to May? Because those typically historically have been good months of the stock market, and then kind of take the summer off. Well, data would suggest otherwise. If we look at the last 7 of the last 8 years have been positive, absent the January through May timeframe. So we don't think that is something to put any real validity into from a standpoint. We're not going to make investment decisions based on that. The summer months typically are just a little bit weaker overall, usually a little less news coming out. Not as many people in and out of stocks, it seems like, over the summer months. But overall, sell in May and go away, not something we subscribe to from a strategy standpoint. And here's one of the slides that we like to look at on a regular and reoccurring basis. And the reason for this is it's not necessarily intuitive. At least it's not for me. But let me explain what we're looking at. Let's assume that your portfolio has a 20% down market. It's down 20%. So you have $1 million and it's now worth $800,000. It doesn't feel good. Let's also assume that you're taking out 4% per year for living expenses, travel, whatever it might be. Maybe logic would suggest that you need 20% or maybe just a little more than 20% to get back to quote unquote break even, to get back to your $1 million where you started. But the way the math works is you actually need 36% to get back to break even, just to get back to your $1 million. And so the reason we bring this up, this really has to do with how we look at investing in retirement. And usually there needs to be a fundamental change in the 2 through 5 years leading up to retirement, where most people in their 30s, their 40s, even late into their 50s, they're really kind of pushing the pedal to the proverbial metal of trying to grow their investment portfolio. But when we're getting a few years from retirement or in retirement, we think we win by not losing. We think the best offense is defense in this standpoint, where we want to minimize some of that downside volatility if and when the market does have a pullback. Most recently, we saw that in 2022. We were satisfied with how our dividend stock portfolios held up during that time frame. But this picture is worth 1,000 words here. This is really why we want to stay away from those really big down years. It's just when you're taking money out of a portfolio, it's just a much higher mountain to climb to get back to that proverbial break even. And with that being said, we typically have clients that will gravitate towards one asset class. Some clients really like the growth potential, and they say, I think we should be a lot heavier in stocks. Some clients will say, well, you know what, a downturn makes me nervous, and I want to be more bonds. I want to be more fixed income. And what we think over time, this is not just our professional opinion, but this is statistically true. Looking at this, we think we're not trying to be the top of the list, the best performing asset class year over year. We're trying to stay away from those being the worst performing. If we look at the top there, real estate, it's been the best performing 8, 10 times. However, if you look, it's also been the worst performing asset 1, 2, 3, 4, 5, 6 times. We think the best place to hang out is more of a blended portfolio. Blended portfolio, that's more of a generic term. We create for each family what we call the family index number. What rate of return does your family need to be successful in retirement? And so we want to take out that downside. It's going to take out some of the upside, but if we're meeting that family index number, that's how we're defining quote unquote success, taking the least amount of risk possible for your family to meet their goals. So I personally actually think this is helpful for me to look at this, to remember that, hey, stocks are not always the best performer. Bonds are not always the worst performer, coming off a period where stocks have done well, bonds have not done well. But the reverse is also true. After a good year for bonds and a poor year from stocks, we don't need to abandon our stock strategy either. So we think a blended portfolio, as we've talked about, clients on the call know, we're big believers in dividend paying stocks, and we continue to believe that. But having a balanced approach is critically important in the retirement years. So that is all we had, kind of right on schedule. Just as a reminder, we'll do these monthly calls. Our goal is to be 15 to 20 minutes. Every third month, we're going to kind of dig our claws in a little bit more and have a little bit more of a robust presentation on the markets. But this is our goal of hoping to maybe provoke a question, a comment, maybe even a snide remark. We tend to get most of our questions by email or phone calls after the presentation. So please don't leave a stranger. If you have any questions, let us know. But from Matty, myself, Randy, and the rest of the team, I want to thank you for spending a few minutes with us, and hopefully educational along the way. So take care. Happy 4th of July, and we'll look forward to catching up soon.